Hey, Finance with Foss here, just talking about some more mortgage and credit stuff. So you're probably here watching this video because you want to improve your credit, or maybe you want to better understand it. Do you feel like you need an advanced degree in credit just to figure out what's affecting your score? The good news is you don't. It actually can be rather simple. So stick around for some useful information on what affects your credit score. Credit scores are a lot like someone's fingerprint. They're all very different and have unique aspects to them. No one's credit is alike or even responds in the same way. As your financial profile changes, so does your score. So knowing what factors and types of accounts affect your credit score gives you the opportunity to improve it over time. Behind the number itself, with credit scores typically ranging from 300 to 850, there are 5 main factors used to calculate credit scores. Lenders use these scores to figure out how likely you are to pay back your debt, and in turn, those scores are often the deciding factor whether you will get a new loan. So what are the top 5 credit score factors? First one is payment history. So when you think of a good recipe for a credit score, your payment history is the main ingredient, and even one missed payment can have a negative impact on your score. Lenders want to be able to make sure that you will pay back your debt and pay it back on time, so when they are considering you for new credit, they take all of this into account. Payment history accounts for 35% of your FICO score, the credit score used by 90% of the top lenders. The next would be amount owed. So your credit usage, particularly as represented by your credit utilization ratio, is the next most important factor for your credit scores. Your credit utilization ratio is calculated by dividing the total revolving credit you are currently using by the total of all of your revolving credit limits. Now, this ratio looks at how much your available credit you're utilizing and then gives you a snapshot of how reliant you are on non-cash funds. So using more than 30% of your available credit is considered a negative impact by creditors. Credit utilization accounts for 30% of your overall FICO score. Now, ideally, we would like to see that below 10, but at least below 20% utilization. Next in line is credit history length. This is how long you've held credit accounts, and this makes up 15% of your FICO score. This includes the age of your oldest credit account, the age of your newest credit account, and the average age of all of your accounts on your file. Generally, the longer your credit history, the higher your credit scores. Fourth one would be credit mix. So people with the top credit scores often carry a diverse portfolio of credit accounts, which might include a car loan, a credit card, student loans, or a mortgage, or other types of credit products. So credit scoring models consider the types of accounts and how many of each you have as an indication of how well you manage a wide range of credit products. Credit mix accounts for about 10% of your FICO score. The final factor for credit is new credit. So the number of credit accounts you've recently opened, as well as the number of hard inquiries lenders make when you apply for this credit, accounts for a roughly 10% of your FICO score. Now, too many accounts or inquiries can indicate that you have an increased risk, and as such can then hurt your score. So typically, credit contains information about 2 types of debt. You have your installment loans and your revolving credit. Because revolving and installment accounts keep a record of your debt and your payment history, they are important for calculating your credit scores. Installment credit usually comprises of loans where you borrow a fixed amount and agree to make a monthly payment towards that overall balance until the loan is paid in full. Student loans, personal loans, and mortgages are examples of installment debt. Now, revolving credit is typically associated with credit cards, but it can also include some types of home equity loans as well. With revolving credit accounts, you have a credit limit and make at least a minimum monthly payment according to how much credit you use. Revolving credit can fluctuate and doesn't typically have a fixed term. How does having different credit accounts affect my credit score? Now, we mentioned this earlier, so credit mix, or the diversity of credit within your accounts, is one of the most common factors used to calculate your credit scores. It also is one of the most overlooked by consumers. Maintaining different types of credit accounts, such as a mortgage, a personal loan, and a credit card, shows lenders you can manage different types of debt at the same time. It also helps them get a clearer image of your finances and your ability to pay back debt. While having a less diverse credit portfolio won't necessarily cause your scores to go down, the more types of credit you have, as long as you make on-time payments, the better. Again, credit mix accounts for 10% of your FICO score and could be a very influential factor in helping you achieve a top credit score. Can service accounts impact my credit score? Now, service accounts such as utility bills and phone bills are not automatically included in your credit profile. Historically, the only way a utility account could impact your credit score was if you didn't make payments and then the account was referred to a collection agency. So in other words, the only way it couldn't help you, the only way it would hit your credit is by hurting you. But this is kind of changing. So a product that Experian uses called Experian Boost now allows users to get credit for on-time payments made on utility and telecom accounts. Experian Boost works instantly and allows users with eligible payment history to see their FICO score increase in a matter of minutes. Currently, it really only way you can get credit for your utility and telecom payments. Through that platform, users can connect their bank accounts and identify utility and phone bills, and then after the user verifies that data and confirms that they want to add to their credit file, they will receive an updated FICO score instantly. Now, late utility and telecom payments do not affect your Boost score, but remember, your account, if it goes into collections due to non-payment, that will stay on your credit report for 7 years. And that collection, it kind of acts like think of it as like a ceiling to your credit score. So as long as it's there, you can only go so high with your credit. Now, when it comes to mortgages, we can exclude these self-reported items from counting against your qualifying debt-to-income ratio when they show up on your credit. So it doesn't necessarily hurt you to put it on there. There's also a new card being built by, well, I say built, but it's called MasterCard Built, and it's a card where they're allowing you to put your rent towards your credit. Now right now it's in early access, and they're only allowing you to get an invite only, but it's something you could sign up for and look into. I haven't done a video on that or investigated it too much yet because it's still kind of a new product, but that is another thing to discuss down the road. What can hurt your credit scores? Now, as we discussed earlier, certain core features of your credit file have a great impact on your credit score, either positively or negatively. So payment history is one of the most important aspects of your FICO score, and even one 30-day late payment or missed payment can have a great negative impact on your profile. High credit utilization can be a red flag to creditors that you're too dependent on credit. Credit utilization is calculated by dividing the total amount of revolving credit you are currently using by all of your total credit limits. Creditors like to see credit utilization under 20%, but 10% or less is even better. This ratio accounts for 30% of your FICO score. Each time a lender requests your credit reports for a lending decision, a hard inquiry is recorded in your credit file. These inquiries stay on your file for 2 years and can cause your score to go down slightly for a period of time. Lenders look at a number of hard inquiries to gauge how much new credit you are requesting. Too many inquiries in a short period of time can signal that you are in a dire financial situation or you're being denied new credit. The type of negative account information that can show up on your credit report include foreclosure, bankruptcy, repossession, charge-offs, settled accounts. Each of these can severely hurt your credit for years, even up to a decade. Now, a good question of what we all kind of want to know, how can we improve our credit? So improving your credit score can be easy once you understand why your score may be struggling. It might take some time and effort, but developing responsible habits now can help you grow your score in the long run and save you thousands of dollars. A good first step is to get a free copy of your credit report and your score so you can understand what is in your credit file. Now you can get a free credit report. It won't give you a score, but you can get the actual report through freecreditreport.com. Now again, this won't give you an actual credit score. So then that's where I suggest using something called Credit Karma. I personally use Credit Karma to monitor my credit, as the app is pretty intuitive and it provides a lot of detailed information. Plus it gives you both TransUnion and Equifax. The next thing is to focus on what is bringing your score down and work towards improving these areas. Now here are some common steps you can take to increase your credit score. Because payment history is the most important factor in making up your credit score, paying all of your bills on time every month is critical to improving your credit. Now, reducing your credit card balances is obviously a great way to lower your credit utilization ratio, and it can be one of the quickest ways to see your credit score boost. So keep those credit utilizations ideally below 10%, but if you can't, at least below 20%. Now, a super easy way to help your overall utilization is to have higher credit limits. Now, having higher credit limits also comes with a risk. You got to keep in mind you'll be responsible for that increased amount of credit, so you got to treat it well and treat it wise. So I really only suggest this if your cardholder is willing to do a limit increase without doing a hard credit pull. Because if you get the hard credit pull, again, it can have compounding negative effects on your credit. So ask your creditors if they're willing to do a limit increase. And I personally do this on my cards like every 6 to 12 months just to see if I can keep increasing my overall utilization and my credit limit. So then if I charge up anything on my accounts, it's, a drop in the bucket compared to if I had a really low credit limit. If you have any payments that are past due, bringing them up to date may save your credit score from taking an even bigger hit. Late payment information in credit files include how late the payment was. So this goes from 30-day to 60-day to 90-day or even 120 or longer past due. So the more time that has elapsed, the larger the impact it has on your score. And keep in mind, these late payments stay on your report for 7 years. Now, we're all human, and so are the people who are in these credit bureaus, so mistakes happen. And your scores could suffer because of inaccurate information in your credit profile. So you want to periodically monitor your credit reports to make sure there's no inaccurate information that can appear on there. If you do find out that something's out of place, you want to initiate a dispute with the credit bureaus. And you want to do that as soon as possible because these sometimes take quite a bit of time. So this is not something that you want to run into when you're, let's say, trying to buy a house. You want to have that taken care of before you'd have your credit pulled by your mortgage loan officer. So I kind of touched on this when we were talking about increasing your credit limits. But you want to limit the number of times when you ask for new credit, and this will reduce the number of hard inquiries you have on your credit profile. Now, these hard inquiries stay on your credit profile for 2 years, and though their impact on your scores fades over time, you just don't want to have a lot of these going on. If you have lower credit, the new credit requests can seem to have more harmful effects on your score than if you have higher credit. One big thing you want to do to avoid the dreaded late payment that will be on your score for 7 years, especially with credit cards and obviously with installment debt, but set up these auto payments so that way it at least makes the minimum payment, even if it's just a tiny small balance. One way to eliminate any possibility of late payments is to make this happen. Doing this at a minimum and then going in and making the manual payments yourself will allow you to never miss a payment since you have the auto payment set up. And then since you're already going in there and making these manual payments, you'll have a better idea of what you're actually spending money on, and it makes it less of a swipe it and forget it type of mentality. Secured credit cards, now they can do wonders to build up your credit since they are designed to do just that, build credit. Now with this in mind, you must treat these cards well. Otherwise, they could have drastic effects on your credit in the wrong way. A secured credit card is just like a normal card, except that it requires a cash security deposit when you open the account. The deposit then reduces the risk to the credit card issuer. If you don't pay your bill, the issuer can then take that money from your deposit, so essentially they're covered. That's why these cards are available to people with bad or no credit. Now, the deposit is usually equal to your credit limit, so if you deposit $200, you'll have a $200 limit. Use this card responsibly, and you can improve your credit enough to qualify for an unsecured card, the one that doesn't require that deposit. Now, going back to why I said you want to treat these well, since they're designed to build credit, if you don't treat it well, it will crush your credit. So again, set up those auto payments and pay these in full on time. So much like a secured credit card, the credit builder loan is designed to build up your score, but this is a different type of credit source. Remember how we talked about there's two different types of credit, with one being revolving like credit cards and the other one being an installment loan like a car loan? This follows the latter. So credit builder loans are installment loans that you essentially pay yourself over time in the form of a fixed payment. Once it hits a completion date, you get a majority of the money back that you've been making payments on, and they keep a small amount from you as essentially their service to you. Now, this is an example of a product that I love to promote, and it's a website called self.inc, where the current offer is 4 credit builder loan options. So you can kind of fit a plan that fits your goals and your budget. Now, I've had a lot of clients use this, and we've had a lot of success in building their score. So I'm not affiliated with this product at all. We've just had really good success with it. An authorized user is essentially piggyback off of someone else's credit history and the length of credit history that they have with a credit card that you're now then added to. With this, it's a great way to start building credit if you're under the age of 18 especially. Now, the key to becoming an authorized user is to make sure to pick a relative that has a strong credit score, a history of making on-time payments, and low credit utilization. Becoming an authorized user on an account with a history of missed payments could actually harm your score rather than improve it. So you really want to be selective of who you'd pick for this, because when we pull credit in the mortgage world, if you're an authorized user, it's going to show on that account. So if they carry a big balance or have late payments, again, it's going to show on there and affect you. If you want to establish and build your credit, but you don't have a credit score, these options will help get you going. So first, get a secured credit card. Now, as we mentioned earlier, a secured credit card can be used the same way as a conventional credit card. Really, the only difference is that a security deposit, typically equal to your credit limit, is required when signing up for the secured card. This security deposit helps protect the credit issuer if you default, and it makes them more comfortable taking risks on borrowers without a credit history. Use the secured card to make small essential purchases, and be sure to pay your bill in full and on time each month to help establish and build your credit. Next would be to become an authorized user. Another previous mention here, if you are close to someone who has a credit card, ask to see if you could be added as an authorized user to jumpstart your credit. In this scenario, you get your own card and are given spending privileges on that main account, so it might be up to them whether they want to give you a card or not. In many cases, credit card issuers report the authorized users to the credit bureaus, which then adds to your credit profile. As long as the primary card holder makes all of their payments on time, you should benefit. Now, if you found this information useful, please hit that like button, as it will help others find this video through YouTube and that algorithm and all that kind of stuff. Also, please consider subscribing, as it helps grow my channel. If you're looking to build credit or dive more into mortgage content, please check out my other videos. And if you have any suggestions on videos that I should make, let me know, and I'll be happy to make them.